Welcome back to Intelligent Investment Today, the podcast concerned with all things value investing. In each episode, we take a different topic from the world of finance and explore it through the timeless lens of Benjamin Graham, the man widely considered the father of value investing and tutor and mentor to none other than Warren Buffett himself. Our aim is to distill the noise of the markets into lessons that remain as relevant today as they were in Graham's time. Lessons grounded in reason, discipline, and an unwavering focus on intrinsic value. In today's episode, we'll be taking a closer look at one of economic history's earliest and most infamous speculative bubbles. A tale so absurd, it reads more like satire than financial history. Yet it happened, and it left a legacy that continues to echo across markets to this day. Taking place in the Dutch Golden Age of the early 17th century, this peculiar episode offers a window into the psychology of speculation, greed and fear. Emotions that remain deeply ingrained in investors centuries later. We'll examine what fueled the bubble, why it all went so disastrously wrong, and why investors, despite centuries of progress, seem doomed to repeat the same mistakes over and over again. So without further ado, let's get right into it. As ever, sit back, relax, and prepare to take on board another lesson in value investing, as inspired by Benjamin Graham. Tulip Mania, or tulip fever, as it is sometimes known, is widely regarded as the first recorded speculative bubble in economic history. It's one of those episodes that, if not for the ample historical evidence, one might assume to be apocryphal. After all, how could a humble flower bulb bring a nation's economy to the brink of chaos? To understand it, we must first set the scene. In the early 1600s, the Dutch Republic stood at the pinnacle of its power. Its merchant fleets dominated the seas. The Dutch East India Company was the envy of Europe, and Amsterdam had become a hub of trade, science and art. This was the Golden Age, a period of extraordinary wealth and confidence. With prosperity came leisure, and with leisure a fascination for luxury. Among the well-to-do, collecting exotic plants became a fashionable pastime. The tulip, newly introduced from the Ottoman Empire, was unlike anything Europeans had seen before. Vivid in colour, elegant in form, and symbolically rare. And so possessing tulips became a mark of sophistication, a statement of taste and status. But not all tulips were created equal. Many varieties were common. Others, the rarest and most beautiful, were the result of a viral infection that caused striking colour variations. These rare flowers, known as bazaars, displayed intricate streaks and flames of contrasting colours. White or yellow patterns over deep reds, purples and browns. Their beauty was accidental, unpredictable, and utterly irresistible to collectors. As the appetite for these rare varieties grew, tulip bulbs began to trade hands for increasingly astonishing sums. What began as a passion for beauty and prestige soon transformed into an obsession for profit. By the mid-1630s, tulip trading had expanded far beyond botanists and the wealthy elite. Ordinary citizens, craftsmen, merchants, even sailors, were drawn in by the allure of easy riches. Tulip bulbs, after all, appeared to do something magical. Their prices only ever went up. At the height of the frenzy in late 1636, contracts for bulbs, many of which hadn't even been dug from the ground, were changing hands multiple times a day. Prices rose to levels that defied all logic. A single bulb could fetch multiple times more than a skilled craftsman's annual income, and in some cases more than the cost of an entire canal-side house in Amsterdam. Trading was often conducted through futures-like contracts, where buyers and sellers agreed on a price months before the bulbs would actually be delivered. It became a speculative market, a precursor to modern derivatives, though one built entirely on optimism, hearsay, and a shared delusion that prices could never fall. People weren't buying tulips for what they were, but for what they believed someone else would later pay. The market detached itself completely from the real-world value of the bulbs themselves. Tulips had ceased to be flowers. They were tickets to fortune. At the centre of it all was a psychological phenomenon that is repeated throughout history. What we might call the greater fool theory. The belief that, no matter how absurd the price, there will always be someone willing to pay more. As Benjamin Graham might have put it, speculation had replaced investment. Prices were no longer anchored to intrinsic value, because in truth there was none to anchor to. Then in early 1637 the impossible happened. The chain of greater fools broke. The spark may have been small, a failed auction in Haarlem, where buyers suddenly refused to meet the high prices. But confidence, once shaken, evaporated rapidly. The market turned almost overnight from euphoria to panic. Buyers disappeared. Sellers scrambled to unload their contracts, only to find that there were no takers. Within weeks, prices had collapsed by over 90%. Fortunes built on paper wealth disintegrated. The fallout was severe. Lawsuits flooded local courts as traders sought to void their contracts, arguing that the agreements were gambling debts rather than legitimate transactions. The Dutch authorities, recognising the potential for social unrest, largely refused to enforce payment, but the damage had already been done. What remained were stories of weavers and brewers bankrupted by speculation, of merchants who sold entire estates for bulbs, now worth a fraction of what they'd paid. And yet, for all its madness, Tulip Mania was not unique. It was simply the first documented instance of a pattern that would reoccur in ever more complex forms across the centuries. The lesson of Tulip Mania is not about tulips at all, it's about us. Human nature. The mix of greed, envy and fear that governs so much of financial behaviour. We may flatter ourselves with the idea that modern markets are more rational, more efficient, but the underlying psychology remains constant. Consider the late 1990s and the dot-com boom. Investors poured money into any company with .com appended to its name, convinced that the internet would rewrite the rules of business. In many ways it did, but that didn't justify paying infinite prices for companies that had neither profits nor plans for them. At the height of the frenzy, firms with little more than a website and a dream commanded billion-dollar valuations. Analysts discarded traditional valuation metrics as obsolete. Graham's simple question, how much are we paying for what we're getting, was nowhere to be heard. When the bubble burst in 2000, trillions in paper wealth vanished, and investors were left holding worthless shares in businesses that never made a cent. Fast forward to more recent years, and we've seen similar stories play out again. In cryptocurrencies, meme stocks, and arguably segments of the AI-driven equity boom. Bitcoin, Dogecoin, NFTs, assets whose valuations have at times been driven more by narrative and momentum than by measurable cash flow or intrinsic worth. Each represent, in their own way, echoes of Tulip Mania. The packaging may be modern, the technology advanced, but the psychology is identical. A collective suspension of disbelief, fueled by the intoxicating idea that this time it's different. For the value investor, these episodes offer both a cautionary tale and a quiet reassurance. Cautionary because even disciplined investors are not immune to the emotional pull of the crowd. But reassuring because the principles laid down by Benjamin Graham serve as a kind of intellectual armour against such follies. At its heart, value investing is about one simple relationship: the price paid versus the value received. Every investment decision must be rooted in the estimation of intrinsic value, the real worth of an asset based on its ability to generate future cash flows. Speculative bubbles, by definition, ignore that calculation entirely. In Tulip Mania, intrinsic value was irrelevant because tulip bulbs produced no income, no dividends, no utility at all beyond their aesthetic appeal. In the dot-com era, many businesses had no viable path to profitability. In modern crypto markets, some assets have no claim to tangible value at all. And yet people continue to buy, driven by emotion rather than reason. Precisely what Graham warned against when he wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." Value investors, by contrast, are guided not by crowd psychology, but by the arithmetic of risk and return. They understand that true wealth is built not in moments of frenzy, but in moments of discipline, In the quiet act of buying what is undervalued, holding patiently, and allowing the market to do what it inevitably does, recognise value, eventually. Tulip Mania reminds us that the question, how much, is perhaps the most important in all of finance. When that question disappears, when investors cease to ask what they're truly getting for their money, speculation replaces investment, and the seeds of the next bubble are sown. The names and the assets may change, but the script does not. From South Sea stocks to railways, from internet startups to digital coins, the story repeats, because human nature repeats. For those who follow the discipline of value investing, that is both a warning and an opportunity. The warning: never let enthusiasm or fear override analysis. The opportunity: when others are driven by mania, value often hides in plain sight, waiting to be discovered by those with the patience to look. And on that note, we'll draw today's edition of Intelligent Investment Today to a close. I hope you've enjoyed this exploration of Tulip Mania, a fascinating case study in human behaviour, and the enduring wisdom of asking always how much. If you found this episode insightful, please consider subscribing or adding us to your playlist. And do share it with a friend or a colleague. It really does make a huge difference. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.